Guys, welcome back to our fifth and final episode in our non-QM webinar mixer at A&D Mortgage. We have had a great time chatting all about non-QM mortgage programs over the last 5 weeks, from the benefits to who they're for and some guidelines around them. The reason we wanted to create this series is to educate our broker community out there with some insights from some of our A&D mortgage professionals. We know that the non-QM space can be a little bit more challenging to understand than the typical conforming landscape. We hope that the information we've shared has been useful and that you can use it in your business going forward. I said it on the first 2 webinars, and I want to say it one last time. We wouldn't exist without you, our broker partners, and we're here to provide you with as much value as possible. Today, we want to wrap up the series by bringing on 2 of our previous guests, Jerry Maharo and Lucy Mantija, and of course, our founder and CEO, Max Sluserchuk. I have all of your questions from the previous 4 webinars, and we'll be answering some of those, but still feel free to submit any of your questions that you have today, and we'll do our best to cover as many of those as possible. So let me get to bringing on our guests. First, we have Max. Now we have Lucy, and now we have Jerry. Guys, welcome to the live stream.
Hey, David. Hey, guys. Thank you, David, so much for the introduction.
Good.
Thank you, David.
Good to see you.
Good afternoon, all of you.
Max, we almost lost you this morning. You're on a trip to New York, and I won't tell them why. It had something to do with misplacing the laptop. But we almost didn't see you this morning, but you happened to borrow a laptop and pull off a miracle. And so we're happy to have you join us. Good to see you.
Thank you. I'm glad to be here at the webinar.
Well, let me start, Max, since this is your first time on one of these webinars. Let me start with you. I thought before we get into the simple Q&A, it would be good for our audience to hear a little bit about why you created A&D Mortgage and the path that you've been on for the past 15 plus years.
Yes, thank you, David. As you know, our main objective at the company is to serve all types of borrowers. That's why we have our name, A&D Mortgage, where we try to serve all the borrowers from A to D. So the main goal of the company is to try to capture as much audience as possible and to help as many borrowers in the community as possible. So this is the main goal, and we keep the same idea as from the beginning till the end. So haven't changed the theme since then.
What major advancements or changes have you seen within our organization from the start to now? What have been some big milestones for you?
As usual, all the approvals, all the agencies, we are not only non-QM lender, we are Fannie and Freddie seller servicer, we're an FHA lender. That all this came with time. That was not our main objective, but a lot of milestones, you can say, in this last 15 years. We got Fannie Mae on board, Freddie Mac on board, FHA on board. We started retaining servicing. Then we started doing our own servicing without using sub-servicers. Each of those milestones require substantial company change, big teams, a lot of new management and new talent. So all those were a lot of work, and I think it's been paying off.
Yeah. So I think historically, we have had a massive focus on non-QM. Of course, we're a full service lender, but we've had a massive focus on non-QM. And I think that's been instrumental to our success as an organization. Talk to me about why you chose to focus so heavily on non-QM, or was it just a natural organic evolution?
We believe that non-QM goes hand to hand with the company philosophy, where we try to serve borrowers from A to with credit from A to D. So it came naturally from the beginning, from the inception. Our focus was on non-QM even way before this term were invented. As the lender with headquarters in South Florida, we always had a lot of investors from across the nation to buy properties in Florida, and a lot of buyers from across the globe to buy properties in Florida. So we did non-QM way before it's even existed. And that was our initial focus, and that these went hand to hand with our philosophy. So it's a natural continuation of the business to get into non-QM and to be active and one of the main leaders of this part of mortgage world.
Yeah, love it. Excuse me, Jerry, Lucy, let me move to you. Let's start with Jerry, but same question to both of you. You guys both have been in the industry for quite some time, and you've both had a focus on non-QM. Similar question to Max. Was that intentional? Was it just an organic evolution? Why choose that main focus on non-QM?
I think for me, David, when I came into the industry a little bit over 20 years ago, I was with hard money down in San Diego, and then I moved to subprime as a subprime started to develop in the early 2000s. So when non-QM came back 5-6 years ago, it was a naturally for me to move into non-QM. These loans are really hands-on for sales on the wholesale side, account executives, really putting them together. They're not cookie cutters. There's a lot of work to do that the AEs put into it. And there's a lot of satisfaction when you get loans done.
Yeah. And Lucy, you?
I would say that the non-QM programs allows us to serve more borrowers and help borrowers to really come to their dream to own a property in the U.S. Because on the conventional side, you just have specific guidelines and certain rules and requirements that if you don't fit on those, you unfortunately cannot buy a property. With non-QM, we are able to bring more borrowers in and help borrowers to buy properties, financing properties, and become investors. There are certain more opportunities on the non-QM side because we are not just black and white guidelines. We also do manual underwriting with exceptions. It's a great opportunity for me to work on the non-QM because help you to think out of the box. And that's what I like about, I feel more comfortable selling non-QM because I have ability to really go with the power of yes, because I have the opportunity always to serve my brokers and give them the opportunity to submit their loans and get approved and closed.
Gotcha. So I haven't chatted much on the previous 4 webinars about 2020, and I feel like that word or that number is starting to become maybe slightly a dirty word or curse word, 2020. But I do want to just ask that real quick. Historically, we've been very strong, as Max, you were sharing, with non-QM. But 2020 was interesting. A lot of the typical borrowers that qualify or go for these non-QM loans just kind of that went away for a lot of lenders in 2020. We were able to pivot very quickly, make some quick decisions, being a nimble company. Max, talk to me about how we were able to make those quick decisions and be able to adjust to the market. And it happened to be, I don't want to answer the question for you, but it happened to be our best, most successful year in the company history. So talk to me about a little bit about, and I know this series is all about Q&A, and we're going to get to that in just a second. But talk to me about 2020 and how we were able to pivot and transition with such a change in the market. And I do think that a lot of non-QM lenders, primarily non-QM lenders, had to close their doors last year because of it. Talk to me about 2020 a little bit, Max.
Yeah, thank you for the question, David. We always been a conforming and jumbo lender as well. It's what happened is historically, our percentage of conforming and jumbo loans were small, but we always been for quite a long time we've been Fannie seller servicing. So the companies during the 2020 period, if you did not sell directly to agencies, that was an issue. Aggregators like Wells Fargo, Fannie Mac, the big guys who are a big player of buying servicing, were shutting their doors and increasing rates drastically. If that wouldn't be for the agency's direct ability to deliver, we wouldn't been able to do that. So that's what happened. We had the agency approval for a long time, and we were delivering directly. You had no chance to sell to aggregators. They just shut their doors. That's why a lot of guys who've been in non-QM, they didn't have the agency approval because it requires substantial operation and a lot. They didn't have that. So they had no ability to deliver to agency. That's why they had to shut the doors. We were able to keep all our operations up and running and even had to increase it due to substantial volume increase in conforming world. And another interesting point to answer your question is regarding non-QM, where we have our fund, which does the securitizations, right? So what happened that we have several institutional investors in the fund who, in addition to all regular bank financing, provide lines of credit to us, and we have committed lines on our Imperial Fund, where we were able to buy and to originate non-QM loans throughout the whole COVID situation in 2020. So we have unusual strategy and unusual funding sources who are investors in the fund and providers of the liquidity with committed lines. So if this happens in a year, I hope it will not, but if something like that happens, we will be able to continue with non-QM production throughout all the problems that some other guys cannot, because the traditional warehousing providers are stopped financing immediately. So we got lucky on that.
That's great insight. Jerry, let me ask you the next question, and then we're going to switch gears a little bit. The non-QM market, it's clearly made a comeback and now, again, a strong, viable market, but there still seems to be some myths out there about non-QM that might prompt some brokers to shy away. Talk a little bit about historically why there might be some myths or misconceptions about, I don't know if it goes back to subprime days or any of that stuff, but talk to me about some of that might cause brokers to shy away from these types of loans.
Yeah, I think some of it is because of that, of the subprime days and the myths of, just the quality of loans that were done back then compared to now. Non-QM is a totally different type of loan. Our average FICO scores are over 700. Our average LTVs are about 75%. So we're talking about a borrower who's really just using alternative income to qualify, or an investor that's using no income. So I think compared to 3-4 years ago, that has definitely, we've had a lot more traction now in non-QM. I think that those perceptions are being less and less, and people are starting to understand that these are a sector of the population that wasn't getting serviced after 2008, started getting serviced, but now products are starting to expand and is starting to get more aggressive to service those borrowers.
Lucy, do you hear from any brokers that shy away from these because maybe the misconception is that they take too long or they're too complex or anything like that?
I agree with what Jerry said. Is the meets understanding of what non-QM is, because the quality of the borrowers that we receive on the non-QM are totally different from the subprime. great credit scores, stable income, years on job. That's what we're looking for, and that's what we are been getting on this. So as soon as you start training brokers, they understand, they experience the loans, and they continue submitting loans, because it's quality loans what we are doing. Stable income, stable borrowers, and that's what non-QM is going into.
All right, let's get into the hardcore Q&A first. We're going to play a little game. Now, I didn't give you guys a heads up about this game intentionally, because I wanted to get true and honest reactions. So we're going to play.
That's not fair. You never told us who I'm going to compete with.
I gave you plenty of heads up of everything else. I kept this one a little bit of a secret. So for our viewers, I don't know if you guys have seen Wired. I think it's Wired Magazine or Wired on YouTube. They have some great videos. They play, it's usually with two celebrities side by side. The two celebrities will answer Google's or the web's most searched for questions about themselves. Now, you three, don't worry. These questions are not going to be pertaining to you personally, but they're pertaining to all things non-QM. So I've got a list of 8 questions here, and these are just 8 quick questions to kick this thing off, and then we've got a few more in-depth questions that we're going to get into after these. So I'm going to start with Jerry. You're on the bottom of my screen. Yes. So you can see each question has a little piece of virtual paper over it. So I'm going to reveal one by one, and I want your first reaction or the answer to the question or any additional thoughts. So Jerry, are non-QM loans coming back? We kind of already answered that, but go ahead.
Yes, they are. They are here.
A little bit more insight. Is that
No, they're back. Like I mentioned before, the product has expanded. Even prior to COVID, I see the product expanding more on non-QM. So I think now, with knowing that rates eventually on the conventional side will start going up, and there's a sector of the population that really might not be able to qualify, even though they do make the income. Broker partners are starting to understand it more and are starting to feel more comfortable with it.
Gotcha. Lucy, you're up next. Are you nervous?
kind of.
Here we go. How do I qualify for a non-QM loan? An easy one.
Easy, yes. Broker just need to pull credit, complete the 1003, and decided what would be the best income way to show the income of the borrowers, because we have different alternatives. We have bank statements. We do have profit and loss only. We have asset utilization. We have a mix of those type of incomes as well. Or if it's an investor, we can give a choice of the DACR, which is no income, no employment. We have all in-house.
Awesome. Max, I don't want to set you up for failure here. I know the other two, they're in loans every day in, day out. You're on the golf course every day, so I hope not to put you, of course, kidding. Max, next one's for you. Can a self-employed person buy a home?
100%. The non-QM loans are designed for self-employed people who have business and write their taxes more aggressively, have depreciations, amortizations, use accrual method or using cash method of accounting. So this majority of our borrowers are self-employed people. So this is the program designed for that. So you always can do that. If you're self-employed, you always can get non-QM loan. You just have to find which type of income qualification you are good for. But 99.9% you can.
Max, you get 100 points for that answer. Well done. Jerry, moving to you next. Mortgage or marriage?
Mortgage, always.
This is a tip. This is a top search, Google search question. Answer how you will. Go ahead.
Mortgage, always. Start building equity. Whether you're an investor, obviously, or you're buying for yourself. No, they go hand in hand, I think, right? Usually when a couple's getting married, they're looking for their next step, or, maybe they go into renting, but definitely a mortgage follows after that. So, yes,
Well,
mortgage.
I think it was a silly question to begin with, so you did your best to answer. Well done, Joe. You get 200 points.
Yes.
Lucy, you're up next. How does my credit score affect my rate?
It affects the rate. We really give the better rates to borrowers that we see that are careless. They care about the way they pay their bills. So it's an incentive. That's why our rates are much better. The adjustment is lower when you have a better credit score. But we don't disqualify anybody that it has certain events with the credit. We still give them the opportunity to have a mortgage and improve their credit for other type of finances in the future. So everybody qualifies with us.
Awesome. 500 points, Lucy. Max, you're up next. What if what if my debt to income is high?
Well, there are many different ways we have income qualification. We have DSCR loan where you don't have any DTI at all. It's for investors. We have income verifications with 12 months bank statement, with 24-month bank statement. P&L, we have qualification with asset depletion. We can combine different incomes. We allow combination of asset depletion and business income, asset depletion and personal income on P&L. We can combine personal income and business income. So if you're self-employed, there is a way to combine a lot of things together just to know the guidelines. You always can figure out the proper way to work with your DTI, as we have so many income streams. Or the other thing, you can buy the rate down. You can pay a little bit more. If you depleted all the resources, you can pay a little bit at the closing and lower your rate and meet this DTI. Plus, in addition to that, we are the program owner and we are the ones who securitize our own loans. We always can make an exception. That makes us unique as few other guys on the market. We can make exceptions. We can allow good borrowers with a little bit higher DTI to qualify for the program.
Awesome. 2 more questions. Jerry, back to you. Can I refinance with my bank statements?
Yes, definitely. So kind of, I know we talked about in the past our concierge service where a broker would go ahead and submit their bank statements, submit 24 bank statements, and we'll do the calculations. And going back to the DTI issue too, if they see the income was more the previous 12 months than going to look back up 24 months, they could submit a 12-month bank statement rather than a 24-month. And right now, there's really no difference in pricing. So yes, we use the bank statements, whether they're personal bank statements or business bank statements.
Good. Lucy, final question. Are jumbo loans qualified mortgages?
Are jumbo loan qualified mortgages?
Are jumbo loans QM?
Oh, yes, we have jumbo loans up to $3 million loan amount. And going back to the question for Max that I liked it, our DTI is 50%. So it's hard for a borrower not to meet the DTI, because also we allow mixed bank statements now, which is personal and business bank statements for borrowers that own a business. So it's hard not to meet our DTI because our DTI is very generous, 50%.
Awesome. All right. So that wraps up our Google's most searched questions.
That's not that bad.
I'd say Lucy was the winner with 1,000 points.
Yeah. Girls. One girl out of 3 boys.
We've got one question that came in over LinkedIn from Jorge Avila. Where does Max? Maybe you take this one. Where do you guys expect non-QM originations to be at in the next 5 years?
Interesting question.
Yeah.
I do believe that everything new is the things what good forgotten things from the past. If you take private label issuances before 2008, that private labels were more than GSC production. So GSC were less than half. So I do believe that non-QM and jumbo market will surpass the GSC production if nothing like COVID or anything like that happens in the next 5 years. So I see non-QM and jumbo market to be more than conforming and government world in next 3 to 4 years, as it was already before 2008. The history is gonna repeat itself, always does.
Yeah. So here's another question that kind of ties into that a little bit. This is from Real Estate and Mortgage MLO show. What percent of purchase business is closed with non-QM? And maybe answer that 2 ways, maybe industry-wide and then A&D mortgage specific.
Industry-wide, as all of us know, due to the fact that rates have fallen after COVID, there was like 70% or 75% refinance world throughout the nation. Since we are focused more on non-QM, our production of non-QM today is 30% of cash out, roughly 15% of no cash out, and I think it's roughly, let's say, over 50%. Say
Purchases.
55, maybe I'm a little off, but over 50% purchases. That's your non-QM market for A&D mortgage today.
Gotcha. So I said on all the previous webinars that we'd do our best on this final one to answer some of the questions that came in that we didn't get a chance to on those individual ones. So here's just a few. They might be a little bit all over the place, not specific to one program. But from Nakia Watts, what is the average time to close if a client provides all necessary documents? Go
30.
ahead, Matt.
It could be anywhere from 30 days, 25 days. It all depends of really, there's a lot of factors right now. Appraisal, obviously, there's a delay on there, but usually it's 25 to 30 days if you're providing all the documentations right up front or as the conditions come in.
I can add to that, Jerry, that we quite often see thank you from brokers for closing loans in 13, 14, 15 days. And it happens a lot. Our underwriting is 24 hours. So if broker cut rates, we can close loan in 2 weeks. And as you know, as we have a purchase market where with A&D, most of the loans are purchases, it might take a little longer because seller is not ready. You need the title. It's a new construction. The builder has to finish up something. The purchases takes delay because you have to coordinate the closing and documents with the seller. But as from our side, we cannot monitor the turnaround with other lenders, but A&D is on 24-hour turnaround time for non-QM, for jumbo, for conforming. So I see quite a lot of closings in 2 weeks. But Jerry is right. Average closing time is like 27 days. I think that's company-wide.
Yeah. So we put a pretty big emphasis on speed to underwrite. So quite often, if not all the time, 24 hours. Why put such a strong emphasis on underwriting within 24 hours? It brings value, yes. Talk to me about that, Max.
Once loan is submitted, we see statistically a lot of loans get approval the same day. They disclose the same day and it goes to underwriting direct. We believe that underwriting is main essence of the business. It's an engine. These have to work very fast and efficient. We've been hiring underwriters forever and training them and putting the main focus on underwriting being fast, not to overcondition, stay focused. And we have teams. We don't have all the underwriters doing the same thing. We have a team who does FHA, team who does conforming. Biggest team, of course, is your NonQM, and the team who does jumbo. That ensures that every underwriter is not mixing up the conditions between FHA and conventional and non-QM. This is the best approach, is to have different teams to concentrate on different type of loans. So it's been working good. So we believe that it's a main business objective to have your underwriting turn time quick. If your turn time for underwriting is fast, then you're closing loan fast. That's the key.
Jerry, another one of our popular programs is our 1 and 2 year P&L only. We got several questions about that. Just give me an overview of who that program is typically for. What type of borrower kind of usually utilizes that type of loan program?
It's going to be your self-employed borrower. It's just another alternative than getting the bank statements. It could be due to the fact that maybe they have a lot of moving parts in the bank statements, and it might just cause a lot of questions and a lot of issues. So they have the income there. So you would rather use the P&L, profit and loss statement, from a tax preparer or CPA going back either 12 months or 24 months. So it's typically just, if they do have NSS for some whatever reason, we do have a limit on those on bank statements. This is a good alternative. But definitely they still have the income, and we're still getting something from a CPA or a tax preparer. And, you have the option to do 12-month or 24-month on that.
Gotcha. Can we focus on condos for just a second? What is the process or program to secure a loan for condos? Lucy, you want to take that one?
Okay, we do no warrantable condos as well as we do full review condos. We go to 80% LTV for full review condos. The difference between our full condo review that it requires reserves. For non-QM, we require 8% in reserves instead of 10% that conforming loans required. We do limited review condos for owner-occupied at 75% LTV. The broker does not have to worry about providing any condo questionnaire. That's something that we do internally because we have a team of processors assigned to different account executives that do a lot of this work internally to alleviate the work that the brokers has to put into any loan. For investment properties, we do 70%. So our LTVs are higher for limited review condos. Yes.
Gotcha. Here's a good question. Just came in from Nicole Sauer on LinkedIn. What about multifamily properties? Is there a difference between 2 to 4 units and 6 to 12 units in any of the, whether it be rates, guidelines, and so on? Jerry or Max, you want to take this one?
Okay, for multiple units on the non-QM, we do for 2 for 4 units. When it's more than 4 units, it's considered like commercial real estate loans that we do not qualify those into the non-QM per se. But we do have another alternative that is the light dog, and we can do those loans that are more than 4 units in a case by case. We go up to 80% LTV for 2 or 4 units, and the adjustment is slightly, so it's very competitive, the rates that we can offer for 2 to 4 units loans.
Gotcha.
Jerry, Max?
Anything to add?
It was a perfect answer.
Max, I'm going to wrap this up here in a bit. We've been scheduling these for 30 minutes and we're 5 minutes over. So I'm going to wrap this up just shortly. But Max, when can or can't we change lender paid compensation to borrowers and vice versa?
Yeah, this is a little tricky question, involves compliance, but yes, we can change the compensation from lender paid to borrower paid with a request to lock desk. If you want to switch back from borrower paid to lender paid, this requires a compliance approval because it's a question of in the beginning it was disclosed with borrower paid. The broker discloses fixed compensation, and once you switch it back to lender paid, that brings it to variable compensation due to the fact that loan amount can vary. So from lender paid to borrower paid, you can switch, no approval needed, just request that from lock desk. Switching from borrower paid to lender paid requires approval to make sure that there is no change between the amount disclosed in the beginning and the amount that we as a lender will pay the broker, but both are possible.
Awesome. Well, let's wrap this up. I know there's several questions that have come in on the social media channels that we haven't covered today. We'll do our best to answer those questions within the chat from one of our professionals, Jerry or Lucy or Max. Your tag. You need to get on Facebook, LinkedIn, and YouTube to answer those questions. Just kidding. But those of you viewing that have submitted questions, we'll do our best to answer those in the chat. But I think we've covered some great information over the last 5 weeks, but I think we've only just barely scratched the surface. We all know that the mortgage industry can be complex, but here at A&D Mortgage, we've invested in our talent, we've invested in our technology, and really we've invested in all of that to the point to where we can just run our business effectively. If you're a broker out there and you'd like some more information, feel free to simply comment on any of those social media channels that you're watching on right now, or send us a DM. We'll do our best to connect you with one of our account executives. If you want to apply to become a broker with A&D Mortgage, just simply visit us on andmortgage.com. Max, Jerry, Lucy, I very much appreciate you taking the time. I know our viewers have probably gained some valuable insight from you all. So thanks so much, and we appreciate it.
Thank you guys.
We'll see you next time. Bye-bye.
Bye-bye.